Hey, welcome to the Motley Fool's Crunchtime series, where we scout out a single company from the story to the opportunities and risks. Time to break down Home Depot, the biggest brand in home improvement. First, my prediction. Investors are unlikely to lose money owning Home Depot over the next 5 years, but I don't expect that it's going to outperform the market. Now, let's dig in. Home Depot aims to be the one-stop shop for DIY home improvement and also earn a large share of the spend from home improvement professionals. There's a good chance if you're watching this video, you're only a few minutes away from one of Home Depot's more than 2,300 stores that average almost 130,000 square feet of total indoor and outdoor space. Home Depot has leveraged its existing footprint of stores to build one of the best omni-channel retail businesses operating, giving its customers the ability to buy the more than 25,000 items they stock in stores online and pick it up the same day, and access to nearly 1 million other total items that can be shipped to the local store for pickup or delivered directly to customers' homes. Customers can also count on Home Depot store employees to provide high-quality service and expertise to help them pick the right products for their job. Lastly, Home Depot has done an exceptional job building an extremely efficient business. It generates better operating results and profit margins than its peers, consistently turning relatively modest growth into outsized earnings growth over the long term. Now, this is a really mature business in a low-growth, cyclical industry. Home Depot's expansion has slowed a lot. It opened its 2,000th store in 2005. Since then, it's only opened about 300 new locations over almost 2 decades, and it plans to open about 80 more new stores over the next 5 years. That puts a lot of its growth on increasing sales at existing stores, or comps growth. Now, more recently, comps are actually shrinking. There's a combination of factors, including inflation squeezing discretionary spending, the ongoing housing shortage that's taking a big bite out of the home improvement industry writ large. But on the other side of that cyclical downturn, a combination of that 3% store count growth and low to mid single-digit comps growth should result in pretty modest mid to high single-digit revenue growth. Now, that might not sound like much, but again, operating leverage is the key. Home Depot has a great track record of turning modest revenue growth into more impressive earnings and cash flow growth. If you combine that with a dividend that it regularly increases, that yields about 2% at recent prices, and across the cycle can make for a pretty attractive, stable compounder, if not a high-growth business anymore. There's also some additional upside. Home Depot acquired a distributor called SRS earlier this year. It's going to add about $6 billion in revenue to the top line. That's not a lot for a company as big as Home Depot, but if it can expand SRS and take more share of a really fragmented distribution market, there is potential to accelerate growth a little bit more. There's risk too. The first risk is continued weakness in the home improvement market. If the housing market remains soft and inflation stays higher than the Fed's 2% target. Fewer people buying homes means fewer people spending to improve them. That's already weighing on Home Depot's results. Now, further, that move into distribution could backfire. There's some overlap with its existing business, and it's a really good logistics operator, but distribution has even lower margins, and acquisitions don't always pan out as expected. There's also the risk that management takes its eye off the ball if it shifts resources and focus away from its retail operations to focus on expanding that distribution. It could hurt the business, could hurt investors as well. Let's get to my prediction. Home Depot, it's an exceptional business. It's the leader in its industry in scale and profitability, but right now the stock's within about 10% of its all-time high, and we're in the midst of a cyclical downturn. It also trades for a premium to its near and long-term price-to-earnings multiple. I don't think investors are likely to lose money owning Home Depot over the next 5 years, but I also don't think it's very likely to outperform the market. It's still a wonderful business. All right, let's wrap this up. At the Motley Fool, your comments make us all smarter. Please comment with your own research and insights about Home Depot. Also, tell us what stock you want to see us tackle next. Go to fool.com/invest to receive the top 10 best stocks to buy now.